Welcome to session 2 in lesson 2. In this session, you will learn the basic principles of implications of the efficient market hypothesis. The learning goals for session 2.2 are: you should be able to describe the benefits and limits of technical analysis. You know how to perform fundamental analysis to evaluate proper stock prices. And students should also be able to highlight the role of portfolio management in active versus passive portfolio management in an efficient market. Let's discuss different types of stock analysis. Technical analysis is essentially the search for recurrent and predictable patterns in stock prices. Although technicians recognize the value of information regarding future economic prospects of the firm, they believe that such information is not necessary for a successful trading strategy. If the stock price responds slowly enough, the analyst will be able to identify a trend that can be exploited during the adjustment period. The key to successful technical analysis is a sluggish response of stock prices to fundamental supply and demand factors. This prerequisite, of course, is diametrically opposed to other notions of an efficient market. One of the most commonly heard components of technical analysis is the notion of resistance levels or support levels. These values are said to be price levels above which is difficult for stock price to rise, or below which is unlikely for them to fall, and they are believed to be levels determined by market psychology. Resistance levels explained in an example. Consider stock X, which traded for several months at the price of $72 and then declined to $65. If the stock eventually begins to increase in price again, 72 will be considered a resistance level. According to the theory, because investors who bought originally at 72 will be eager to sell their shares as soon as they can break even on their initial investment. Therefore, a price near 72 is a wave of selling pressure which will exist. Such activity imparts a type of memory to the market that allows past price history to influence current stock prospects. The question is whether a technical rule that seems to work will continue to work in the future once it becomes widely recognized. Once a useful technical rule or price pattern is discovered, it might be invalidated when the mass of traders attempts to exploit it. In this sense, price patterns ought to be self-destructing. Now let's have a look at fundamental analysis. Fundamental analysis uses earnings and dividend prospects of the firm, expectations of future interest rates, and risk evaluations of the firm to determine proper stock prices. Ultimately, it represents an attempt to determine the present discounted value of all the payments a stockholder will receive from each share of stock. If the value exceeds the stock price, the fundamental analyst would recommend purchasing the stock. Once again, the efficient market hypothesis predicts that most fundamental analysis also is doomed to failure. If the analyst relies on publicly available earnings and industry information, his or her evaluation of the firm's prospects is not likely to be significantly more accurate than those of rival analysts. Only analysts with a unique insight will be rewarded. The trick is not to identify firms that are good, but to find firms that are better than everyone else estimate. Similarly, Troubled firms can be great bargains if their prospects are not quite as bad as their stock prices suggest. Let's discuss active versus passive management. Competition among investors ensures that any easily implemented stock evaluation technique will be used widely enough so that any insights derived will be reflected in stock prices. Only serious analysis and uncommon techniques are likely to generate the differential insight necessary to yield trading profits. An active management is more expensive and suitable for very large portfolios. Proponents of the efficient market hypothesis believe that active management is largely wasted effort and unlikely to justify the expense incurred. Therefore, they advocate a passive investment strategy that makes no attempt to outsmart the market. A passive strategy is usually characterized by a buy and hold strategy. A common strategy is to build an index fund, ETFs, exchange traded funds at very low costs. How does market efficiency affect portfolio management? If the market is efficient, why not pick stocks by throwing darts on a list of stocks instead of trying rationally to choose a stock portfolio? There's a role for rational portfolio management, even in perfectly efficient markets. Rational security selection, even in an efficient market, calls for the selection of a well-diversified portfolio, providing the systematic risk levels that the investor wants. Rational investment policy also requires that tax considerations are reflected in the security choice. Investors' optimal positions will vary according to factors such as age, tax brackets, risk aversion, and employment. The role of the portfolio manager in an efficient market is to tailor the portfolio to these needs rather than to beat the market. Resource allocation. Inefficient markets lead to systematic resource allocation as shown on the dot-com bubble of the late 1990s, which sent a strong but, as it turned out, widely over-optimistic signal about prospects for internet and telecommunication firms, and ultimately led to substantial overinvestments in those industries. Before writing off markets as means to guide resource allocation, however, one has to be reasonable about what can be expected from market forecasts. In particular, you should not confuse an efficient market where all available information is reflected in prices with a perfect forced market. As we said earlier, all available information is still far from complete in information, and generally, rational market forecasts will sometimes be wrong. Sometimes, in fact, they will be very wrong. What are event studies used for? An event study describes a technique of empirical financial research that enables an observer to assess the impact of a particular event on a firm's stock price. A stock market analyst might want to study the impact of dividend changes on stock prices, for example. An event study would quantify the relationship between dividend changes and stock returns. Isolating the part of a stock price movement that is attributable to a specific event is not a trivial exercise. Let's discuss how these tests are structured. The general approach starts with a proxy for what the stock's return would have been in the absence of the event. The abnormal return due to the event is estimated as the difference between the stock's actual return and this benchmark. Several ways for estimating the benchmark return are used in practice. Let's reuse the single index model discussed in the previous session, where stock returns are determined by a market factor and a firm-specific factor. Solving for ET, which is the part of a securities return resulting from firm-specific events, result in a function depending on the market's rate of return Rm of t. And the parameter P is measuring the sensitivity to the market return. Parameter A is the average rate of return the stock would realize in a period with zero market return, and the stock return RT. The residual Let's discuss how tests are structured. The general approach starts with a proxy for what the stock's return would have been in the absence of the event. The abnormal return due to the event is estimated as the difference between the stock's actual return and this benchmark. Several ways for estimating the benchmark return are used in practice. Let's reuse the single index model discussed in the previous session, where stock returns are determined by a market factor and a firm-specific factor. Solving for ET, which is the part of a securities return resulting from firm-specific events, results in a function depending on the market rate of return Rm, the parameter beta measuring the sensitivity to market returns, and the parameter alpha, the average rate of return the stock would realize in a period with a zero market return. And the last factor is the stock return RT. The residual ET is the component due to the event in question. It is the stock return over and above what one would predict based on broad market movements in the period given the stock's sensitivity to the market. Let's make an example of abnormal returns. Suppose that the analyst has estimated that A is equal to 0.05% and B is equal to 0.8. On a day that the market goes up by 1%, using the previously discussed formula, you would predict that the stock should rise by an expected value, assuming that ET is equal to 0, by 0.05 plus 0.8 times 1 equal 0.85%.
Das hat's gelöscht. Was ist los?
Let's make an example of abnormal returns. Suppose that the analyst has estimated that A equal 0.05% and B is equal to 0.8. On a day that the market goes up by 1%, using the previously discussed formula, you would predict that the stock should rise by an expected value, assuming that the abnormal return is equal to 0, by 0.05 plus 0.8 times 1 equals 0.85%. If the stock actually rises by 2%, the analyst would infer that firm-specific news that they caused an additional stock return means that ET is not equal 0. So, solving for the abnormal return ET, we can compute 2% minus the previously calculated predicted expected value of 0.85% equals 1.15%. This leakage of information. One concern that complicates event studies arises from leakage of information. Leakage occurs when information regarding a relevant event is released to a small group of investors before official public release. In this case, the stock price might start to increase, in the case of good news, days or weeks before the official announcement date. Any abnormal return on the announcement date is then a poor indicator of the total impact of the information release. A better indicator would be the cumulative abnormal return, which is simply the sum of all abnormal returns over the time period of returns. The cumulative abnormal returns captures the total firm-specific stock movement for an entire period when the market might be responding to new information. Let's make an example of using abnormal returns to infer damages. Suppose the stock of a company with market value of $100 million falls by 4% on the day that the news of an accounting scandal are published. The rest of the market, however, generally does well that day. The market indexes are up sharply, and on the basis of the usual relationship between the stock and the market, one would have expected a 2% gain on the stock. What would be the impact of the scandal on the stock as a percentage and in dollar terms? Now we can actually calculate. So we lost out 2% on the market, and in addition, we lost 4% on company level, resulting in a damage of 6%. Now in dollar terms, we have a total market value of 100 million times the loss of 6% results in a damage of 6 million. We are at the end of session 2.2. After having carefully studied the slides and relevant chapters in the book, please start with the review questions.